Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what people are sharing, and I will share my opinion as we go. It's at @Finance if you want to follow me. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics to find commodity investment ideas out in the world. So no market cycle has ever been like this one, despite multiple blow-off tops, bubbles, and reckless risk-taking. It just keeps going and going. Sounds like a bunch of money printing to me. And this guy below, he's got a couple of charts here. This Yuri, or whatever his name is, that says if this is a new bubble, the next several years will be fun. He's got this going up like this, coming back, in a potential 96 to 2001 type move. Is it possible? It's maybe possible. But I see the lead-in fractal isn't necessarily the same here. So that's where things break down a little bit. We've got a accumulation cylinder going on this, and then the eventual break. This one looks a little bit different here, but it could be. It very well could be, and maybe we get a monster blow-off top in the NASDAQ, NDX. That's possible. It really is. I just don't play over in those areas where bubbles, or I should say, where valuations are in bubble territories. I avoid those areas, and if I miss this type of move, that's okay. It's okay with me. I go where the value's at. I'm going to stay in that value. It gives me the best risk reward, and I'll ride those areas. But that very well could be a possibility. Not denying it. Oil still being the contrarian trade we want it to be. The latest Bank of America fund manager survey shows that energy exposure has been cut the most alongside materials. So Eurozone utilities are up top. Those are generally like recessionary type moves, and that's where people are going into. And then the bottom portion is materials and energy, which is late stage or late cycle movers. So that's what we've got going on at the moment there in terms of rotation into EU utilities and REITs out of materials, energy, and Japan. There's some critical thinking skills. I'll go over this one later. I'll give my opinions here, but we'll come back to that. House price changes by state since 2023. So this is Q1 2023 to Q1 2024. I know there's a lot of housing bears out there, but that doesn't look like a bear market to me, at least not yet. So we've got a couple of 12% gaining states, or I should say 10% plus up in this region here. And then we've got a lot of, I would say, +4 to +6% areas everywhere else, with a couple of 10%ers sprinkled within. So everything is up greater than 3% or more, signaling where we're at in the real estate cycle. Now, I know a lot of people look at some of the data. They look at the data and say, well, we're going to have this housing crash. I always say that if you look at the data back in history, it is very, very rare to have a down home price year and have inventory less than 6 months. I'm not saying that it's impossible, because I think we pulled some anomalies off like a year or two ago in some cities with the interest rates going up as quickly as they did, and we saw some prices flatten out or go slightly negative with inventory less than 6 months. But the general rule of thumb is if you're under 6 months of inventory, home prices go up. If you get above, say, 6 months to 8 months, then you get a variety of outcomes. But it's usually around the 0%. So some years are up, some years are down when you have 6 to 8 months of inventory. And then when you're above 8 months of inventory, that's when you generally see price pullbacks. So right now we've got low inventory. I think it's around 3.5, 4 months of inventory. It's below 6 months, so it's still a seller's market in that sense. But things have slowed down. They have slowed down in terms of sales and stuff like that, and that could be before home prices start to slow down. But we got to see inventory go up. Is my opinion. Coming down to this guy, every commodity bull case is perpetually 2 years away from playing out, is what he says. I don't think that's necessarily the case. We had a big commodity surge, which I consider to be the first wave of the move. Now, could we all be tricked by the first wave being the stimulus money that created a false start? Maybe. That maybe could be the case. And maybe we go through a technology bubble phase before the big commodity boom comes. That's very well a possibility. But the value is there, and we very well could be done with the first wave and maybe almost done with the second wave, and we could get a third wave here at any second. Just because someone's opinion says every commodity bull case is perpetually 2 years away doesn't mean it can't occur. We could see precious metals rip and or oil rip here in the very short term. And a lot of these people be wrong. So you can hold that opinion where, commodity bull case is every 2 years away, but that doesn't change the fact that the market's going to do what the market's going to do. Does not matter. We don't need to reach consensus. The market's going to go when the market's going to go. And a lot of the charts that I see are breaking out of basing periods, entering stage 2. And this statement, in my opinion, is probably incorrect. If you look, a lot of shipping companies and all these other companies, they've broken out of their bases already and are moving higher. It says, we think of free cash flow per share growth as the primary metric correlated with intrinsic value growth. 100%. Write that down. Free cash flow per share growth is the primary metric correlated with intrinsic value growth. That's it, guys. If you had one metric to watch, that's the metric I would watch. Totally. Cycle Bottom says 2025 to 2027 expect massive outperformance. So small cap stocks post the worst first half in history relative to large caps. There's that big down candlestick there. That's the Russell 2000 heads for the worst first half to a year in history relative to the S&P 500. And this is probably where I would be looking. Always look for those things that are underperforming and or are down. We don't want to buy things that are moving down. We want to buy things that are down in relationship to other things that are bottoming and ready to turn up, is what I would say. Charlie Balillo says, manufacturing construction spending in the U.S. continues to hit new record highs, more than tripling over the last 3 years. Now, I hate to say this, guys, but this isn't what a recession looks like. Generally, you get a turn before the recession or during or right at it. So those are slowdown periods here, are these moves lower. And this very well could roll over. I'm not saying it can't. But that's what we're seeing here with construction spending. It is up 206% last 3 years. Most central banks will be in easing mode by the end of 2024. This is for liquidity. 80% of global central banks are expecting to be in easing mode by the end of 2024 versus only 10% in July of 2023. And that makes me think that gold's going to go higher. Yield curve could maybe uninvert. Maybe we do get a slowdown and gold rips it. That very well could be a possibility, and we'll have to watch if yields decline here. And remember, just because we have this chart here doesn't mean that the outcome is exactly that. This is a projection. Housing's in a bubble compared to what? Priced in dollars, almost everything looks like a bubble, which means maybe it's not a bubble you're seeing, but a devaluation of a currency. I like what Joe is saying here, Joseph Brown. This is the average U.S. home price new measured in ounces of gold from 75 to 2024. Housing outperformed from 80 to 2000. Then we had from 2000 a massive outperformance of gold all the way to 2011. And it's consolidating sideways at what I would consider to be on the more expensive side of housing being cheap and gold being more expensive. But that doesn't mean that we can't pull down again and hit a very low out in the future where gold still outperforms housing. Housing, I don't know if it's in a bubble when you start looking at things relative to other assets. That's when it becomes really difficult because a lot of people say, oh, housing's in a bubble. Yeah, compared to median salary, maybe. That could maybe be the case, but that would also indicate that you have a shortage of homes in the market and that the median home buyer is being priced out. If we are in a bubble, this is how you determine if you're in a bubble, in my opinion. If you were to cut rates in half in a bubble where you're in a hyper supply phase, those cut in rates do absolutely nothing to the price of home prices. If you were to cut the interest rates in half today, I would think that home prices would go up, not down, based off of the low inventory and the deficits in the housing market. If you were to increase the affordability like that, I think home prices would go up. And that's how you know you're not in a bubble. Because you cannot be in a bubble and have home prices go up by lowering rates a little bit. Almost every housing bubble that has burst had home prices go down with interest rates and affordability got better, and it did not change the housing market materially in any way. There is a bubble right now in China in their housing market because rates have been cut, stimulus is going, and they cannot bring those house prices back. It's not easy. That's a bubble. U.S. break-even WTI prices for new and existing wells, according to the survey done by the Federal Reserve Bank of Dallas. So U.S. break-even WTI prices for new and existing wells. Look at the difference here. The old wells are about $45 to $31 and somewhere in between. The new wells cost between $59 and $70 a well. That's your break-even point for the crude price. So costs are increasing for crude oil. This was, so someone says breaking, U.S. new home inventory awaiting a buyer surged to 99,000, the highest level since 2009. In just 2 years, the number of these homes have doubled. So if you look, the U.S. new housing inventory flashing a warning sign here is what he's got. And then he's got the housing starts of one single family homes dropping downward. Logan is just reminding everybody, he says 2007 active inventory was 4 million. 2024 active inventory is 1.1 million. Historical average for decades is 2 to 2.5 million. Another thing is you want to compare the completed homes, not just everything in work in progress. So how can you be in a bubble when you have no inventory? You cannot be in a bubble with no inventory. It is impossible. By definition, you cannot have that. A bubble is when you enter a large inventory of whatever it is. It is an abundance of inventory. If you lack that abundance, you can't necessarily be in a bubble. Now that can change. We can accurately say that if this were to go straight up over the next few years, that we go into bubble territory. Totally agree with that. But it's kind of hard to state that when inventory is at such a low level today. Nvidia recently earned the most valuable company in the world status with an enterprise value of $3.3 trillion, a record 11.7% of total US GDP at its recent peak on June 18th, more than twice as high as Cisco's achievement in the year 2000. So is this a bubble? I mean, would I buy this up here? There's no chance in heck I would buy Nvidia at this location. Does that mean it can't go higher? Doesn't. I'm not stating that it can't go higher. I just wouldn't put my money in it at this type of valuation in relationship to a lot of other assets. And maybe the valuation is still, it could still go up. It could. and it could still get more bloated. But I just don't take chances like that. And this is one of the most overvalued, or I should say, is one of the largest chunks of GDP versus anything in history for a single company. Another major steepening of the yield curve, the recessionary signal this sends cannot be overstated. Just so you know, 82% of the entire curve remains inverted. And that means generally when this uninverts, we could get a recession. So COVID recession, the housing bust, tech bust, S&L crisis, double dip recession, and then the 73 inflationary bust. Based on preliminary data, we've got silver, or the Shanghai, ended the day at $33.24 an ounce on the Shanghai Gold Exchange. It's $3.94 per ounce above the LBMA benchmark. God, that's a big divergence there. So again, the metal continues to move from west to east, and this price differential is going to cause that movement. And you can see historically how these were correlated and how that correlation is breaking apart. And the gap between the two is starting to accelerate. And there's the premium difference there going on up with time. I like that, the gap. You're probably doing a lot better than you realize. So let's go over a couple statistics here. It says the average consumer debt is $23,000. Only 7% of Americans make above $150,000 a year. 37% of Americans aren't investing for retirement. 66% of Americans are living paycheck to paycheck. 43% of Americans expect to be in debt over the next 1 to 5 years. And 56% of Americans don't have $1,000 saved for an emergency. My God, that is really scary. So don't let social media fool you. You might be better off than you realize. Macro Micro says Shanghai Containerized Freight Index keeps climbing, rising another 6.87% to 3,714 points. It has now increased for 12 consecutive weeks, reaching its highest level since early 2022. So that's a pretty big move there in the Shanghai Containerized Freight Index. Charlie Munger says, if you make yourself a very reliable person and stay reliable all your life, faithfully doing whatever you engage to do, it will be very hard for you to fail at anything you want. And here's another one from Warren Buffett. The trick in investing is to just sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, swing, you bum, ignore them. JPM predicts the S&P 500 to return 0% over the next 5 years. Would you stay invested and continue to invest? Question mark. Yeah, probably, but I'm not going to be in the S&P 500. A challenge like we've never seen before, the North American Energy Reliability Council estimates 65% of North America's interconnection areas are at risk of a power shortfall this summer. Third of nuclear plant owners in talks with tech firms to power up AI data centers. And I'm not going to go over that because I think I went over that last time. Let's go back to this logic one real quick. I wanted to talk about this because it does impact your way of critical thinking and breaking down information. And I just want to bring this up. It says, here are kinds of questions you should ask. And my questions are completely different than what's on this page, and that's why I wanted to talk about it. So I'm just going to zoom in on it a little bit here. Oh, it looks like I can't. It says, does this information completely and objectively satisfy my needs? If so, why not? I don't really ask that question unless I am looking at something. It says, is the provider of the information qualified to distribute it? I don't ask that question. I think that's a really crappy question to ask. I would look at, where did this data come about? Is it accurate data? Garbage data in is garbage data out. It says, is the information current or outdated? If so, can newer information be found elsewhere? That depends on what it is. Is there any evidence of prejudice or unfairness? That's a stupid question because that doesn't matter in my opinion. Data isn't prejudice or unfair. This is basically what they would, so they would ask this question in like a women's studies class that I went through. Absolutely, I don't know. I don't get that question. Are subjective statements presented instead of facts? Yeah, you do want to check for that, but is the information propaganda or an advertisement? What was the person or organization's purpose or motive in providing this information? Is the information telling the whole truth or just one side of the story? Are the better sources of information elsewhere? And what I do, and I know this is what they put down. This is the questions that I ask. What's the useful purpose? Like what is the usefulness of this information that they are presenting? If there's no point of presenting this information, why use it? A lot of people, if you look at the housing market data, I just went over some of that information here, where the guy was posting, well, there's all these homes in inventory. But when you look at the existing home inventory, there's no homes. So you cannot be in a bubble if there's no homes in inventory. Now that can change, I get it, but you can't immediately be in the bubble. It might take a couple of years for that to materialize, and that's why home prices continue to go higher in the short term, at least. Not all cities may be in bubbles either. So you can read one city that is maybe has an over inventory, it's got too much inventory in a hyper supply phase, and other cities may not be like that. So you have to look at that as well. It's not just one city is going to be a representation of everything. A lot of things that I see in critical thinking that may impact your investing is the way that they set up the axes, an x-axis and a y-axis. You have to ask yourself, are these two things, are they appropriate to be measuring it? And the data, you can cut and slice data a certain way. Another thing is the x-axis appropriately labeled and is the y-axis appropriately labeled? So if I want to show home prices, you're not going to see a percent gain in inventory because that doesn't tell you anything. What matters is the absolute level of inventory. The percent gain doesn't tell you anything, or the percent decrease. Is it coming from a high level? Is it coming from a low level? You need to know what the drivers of that data are. So you can look at a bunch of data, you can present a bunch of data that doesn't mean anything. You're looking at, let's say, like tertiary movements in a market. So what's tertiary mean? Tertiary means it's secondary, like you've got these main drivers, they drive forward, and you're looking at the data behind it, and that data behind it are the lagging, it's the lagging data. So a lot of people look at lagging data and try to make forward-looking conclusions, which I think is just a waste of time. You want to find the leading indicators. The leading indicators are the indicators that change, and their change will tell you an immediate difference of what's coming behind it. So looking at the data behind something may not be as valuable as looking at what's leading it. So for instance, in business, they would do a lot of lagging indicators, and I'm like, this is absolutely not worth anything. Deliveries is not a leading indicator. Like if you're shipping something from a facility, it's not a leading indicator. A leading indicator is your work in progress and that everybody has something in the stage and is pushing everything out the back end. If you have problems upstream, then your shipments are going to have problems downstream. So in investing, you want to look for leading indicators. What is driving the movements? So a lot of people, and I've seen this on Twitter here, they're using a bunch of lagging indicators, and then they're trying to project forward what that looks like. All I'm going to say is they're not going to be very accurate, and they're probably going to have a lot of false predictions, so to speak. You want to look at leading indicators. Leading indicators, and some of the stuff I went over today is leading. But leading indicators are what lead. Inventory levels at low levels are generally indicative of increasing prices. If inventories start to move up, they'll hit a critical stage where prices will start to go neutral or lower. You can look at rate of change things, but your rate of change, which is your percent increase, is not something that you want to look at and gauge because you don't know where it's coming from. It's coming from a high level. It's coming from a low level. Like it doesn't give you enough data. It just says your rate of change is moving to some degree. And if you're looking at rate of change of an inventory level and you're coming from like nothing, then your rate of change will be big in the beginning because you're coming and dividing off of a denominator that is nothing. So you have to kind of look at the data and question the data, like what's the purpose of this data? Is it a leading indicator or a lagging indicator? And how can I use the data to form an opinion of whatever I'm trying to form that opinion from? What I found is there's a ton of data that people use that's just completely worthless. Like it doesn't mean anything. And I don't know why they're sharing it. There's a lot of that data on Twitter, and I try to filter all that junk out. So again, look for leading indicators, and those leading indicators can paint a picture of maybe what's coming for the company or for the sector or for whatever it is. But I just wanted to make that comment as I saw that, and I know it's important to see data, draw accurate conclusions from the data, and then form opinions about how you might move with investments. I'm on a longer term time frame, so the short term data noise is just noise. And most people focus on the short term data noise, which I think is all just, it's garbage because you can't really use it anyway. And before that, keep in mind too, that a lot of the people who position large sums of money get the data before everyone else. So they're making decisions before you are on data that you don't even know exists yet. Keep that in mind as well. And I don't see it as a huge benefactor to retail investors to know some of this data. But that's what I'm going to end it on, guys. So that's all I've got. Give me a thumb up, subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.